So go to chapter 32 in economics, monetary policy. We're talking about monetary policy. We're talking about policies that are put in place by government to correct or to manipulate the economy. But most of the time we use monetary policy when we find out, when government use monetary policy when they find out that there's inflation in the economy. So that means there's increase in the aggregate demand in the economy, which as a result, prices are getting higher every day that passes by. So government could use monetary policy to correct or to make sure aggregate demand is at par with the demand of the customers. So if demand for products is increasing and prices are increasing too, to correct market failure or to control aggregate demand. The other said, this approach of demand to demand management is called monetary policy. Aggregate demand in the economy is affected by the total amount of money. The money that is the money supply. Money else which can be coin, which can be so that the amount or any financial institution interest is the price of borrowing or saving. This one is set by the central bank of the country, which is the government. Do you get it?
Yeah.
So they said, for example, let's forget about that. They said, let's go to the first sentence. This means that to distract people from taking the loan. Do you get the point here? What? Taking the loan. So rather you want to discourage them.
So let's people take loan.
Especially unsecured loans.
Yeah.
I think it's
less business. Maybe
so yeah, but it's most of the time banks they want to make sure there's security. Yeah. You have collateral to stand if they want to give you money. They don't want to lose their money. Yeah. The third point, the amount paid to borrowers is higher than the amount given to savers. This allows money lenders such as banks to make profit. So most of the time, those that borrows money, the amount you have to pay in interest is always higher. That is how banks, that's how they can make money. You understand? But you that you are saving, but you that you are saving, the amount of interest you get is less.
I save money.
Yes, you get interest, but that amount is less than those that are borrowing money. So the banks can make more profit. Is it clear? Yeah. And the last one they said, some of highest rates of interest are charged to credit card users. So yeah, credit card users, you take higher rate of interest because here you're going to spend you're going to spend unlimited amount of money that you don't have presently. So yeah, you have to pay higher interest rate. Is it clear?
Yes.
So now we go to the role of central banks in setting interest rate. I told you earlier, I said the central bank of the country is saddled with the responsibility of setting interest rate. I said that, right? Yeah. So what is the central bank? The central bank is the apex bank, the highest bank in every economy. That's the central bank. So here they said in many countries, interest rates are set by a central bank. Central banks play an important role in the economy by one, implementing the government monetary policy and regulating the banking system. So it is the central bank that comes up with this policy and ensure that other banks follow suit, other banks comply with those policies. That was the first point. Is it clear? Yes. Acting as a lender of last resort to commercial banks. So when the commercial banks are short of cash, the only institution they could go to is the central bank. That's the last resort. Is it clear? The third, is it clear, please? Yes. The third point, controlling inflation and stabilizing emissions currency. The central bank makes sure that prices are stable in the economy and the currency is not depreciating every now and then. It's not devalued. Yeah, is it clear? Yes. And the last point here is setting interest rate. Setting the price which borrowers have to pay and the price which savers have to pay. Clear? Yeah. That's the interest rate. Yeah. Any questions about that? So we'll move on to page 262. Are we there? Yes. 62. Okay. Are you there? Yeah. The impact of interest rate changes on macroeconomic objectives. About macro, talking about the demand for and supply of goods within us. That is macro. Changes in the level of interest rate can have an impact on a number of economic variables and help to achieve a government's macroeconomic objective. Macro, sorry, that's aggregate demand and supply. I was thinking about micro here. Macro, the study of the whole economy.
Yeah.
All right, so first, the impact on inflation. What is inflation? Inflation is the persistent rise in the price of goods and services in an economy, right?
Yeah.
So the monetarists believe that inflation is caused by the money supply growing too quickly. They say that the way to reduce inflation is to slow down the speed at which money is being supplied in the economy. So this is likely to involve raising the rate of interest. When interest rates are higher, borrowing is likely to fall, and the money supply grows less quickly. This will help to reduce aggregate demand in the economy and limit price increases. So the first point is inflation. So the impact of interest rate on inflation is this. For monetarist economists, they believe that inflation with high inflation rate is as a result of increase in money supply. That money supply in the economy is growing at a very high speed. So to reduce that speed, we have to reduce money supply. And how are we going to be able to reduce money supply? We have to increase the interest rate. By increasing the interest rate, people would stop taking money. Rather, they will start saving. Do you understand the point here? So as a result of that, the firms, businesses will not be selling as they used to sell. They don't have any other options than to attract customers by reducing the price. That is how interest rate will correct inflation. Yeah, is it clear? The second point, the second point is unemployment. So a government might use lower interest rates to reduce unemployment. If interest rates were cut, there would be an increase in demand for loans. As a result, spending by firms and households would increase. This would increase aggregate demand, and firms would respond to producing more goods and services. This means they would need to recruit more staff, and therefore unemployment would fall. We call these expansionary monetary policy. The first one we talked about, which is inflation, contractionary monetary policy. At that point in time, government is trying to reduce aggregate demand. To reduce aggregate demand, government use contractionary monetary policy. To increase aggregate demand, government use expansionary monetary policy. When they use expansionary monetary policy, it reduces unemployment. How? If interest rate is falling, it means that we have the incentive to borrow more money. So households will be able to borrow more money. Businesses will be able to borrow to invest. Yes or no?
Yeah.
So the ability for households to have more money with them makes their purchasing power to increase. Yes or no?
Yeah.
So the demand for goods and services will rise. Firms would need to meet up with the demand for goods and services. How are they going to be able to do that? By recruiting more workers. So that is how interest rate will solve unemployment problem. Is it clear?
Yes.
The third point, economic growth. They said monetary policy might be used to help smooth out the small variation in the economic cycle. For example, monetary policy might be used to help get an economy out of recession. The reason for this is to stimulate more economic growth. The global economy has been weak and then, okay, so government could use monetary policy to stimulate economic growth. How? Government might reduce interest rate. So if government reduces interest rate, what happens? A lot of businesses will be able to produce goods and services. Yes or no?
Yeah.
So their ability to produce more goods and services would mean that they will be able to sell more. And output will increase in the economy. They'll be able to use equipment, machinery to increase their output. And if that is done, the economy will start to become active. Then recession will fall. Then they will call it, they will recover, the recovery period. Then after that, boom will start again. Do you understand? Yeah. The last point here. Current balance. We're talking about current balance. We're talking about the balance of payments. The government would use, yes, they said it. The government would use monetary policy to adjust the balance of the current account. To reduce the deficit, the government might decide to tighten monetary policy. This would lower aggregate demand and reduce spending on imports. So the balance of payment current account, which talks about the record of import and export. So if government wants to, well, you know one thing, when import increases, when import exceeds export, it brings up about balance of payment or balance of payment current account deficit. So how will government correct this deficit? Government will increase interest rate, and as soon as government increases interest rate, money will not be flowing as it used to flow. So people won't have enough money to buy imported goods. Yes or no? Yeah. So importation would fall as a result of that. Then, little by little, the current account deficit might become normal or become surplus. Is it clear? So the income of, okay, that's about that. I talked about it already. So go to the page 263. Are you there? It says the mechanism by which interest rate changes affect consumers and firms. So whenever there is changes in interest rates, it can have impact on aggregate demand. We already know what aggregate demand is, the sum of the total demand in the economy. So the impact occurs because of the way consumers and firms respond to changes in the interest rate. So how do consumers and firms respond to changes? That is the point we have to talk about. So the first one, they said consumers. What happens to consumers? They said when interest rates fall, demand for loans from households will rise. Consumers are likely to borrow money to buy goods such as cars, furniture, holidays, because borrowing is cheaper. Also, when interest rates fall, consumers with a mortgage may find that their mortgage payments fall. This means they have more money to spend, which will also increase aggregate demand. Finally, if interest rates are lower, the reward for savers is also lower as a result. This might encourage people to spend rather than save. In contrast, when interest rates rise, consumers try to reduce borrowings because it becomes expensive. As a result, demand for goods using borrowed money will fall. Also, mortgage payments will rise automatically. Therefore, households will have less disposable income to spend and will have to cut some of their expenditures or reduce savings. So now the impact of interest rate, the impact of high interest rate and low interest rate to consumers. This is what I want to discuss now. So let's talk about low interest rate. When interest rate is low, when interest rate is low, the first point is that consumers will have the opportunity to borrow so much money because the interest rate is low. They have so much opportunity to borrow money.
I can loan and then the interest rate very low.
Yeah, because the cost of borrowing is cheap.
Yeah.
So what happens afterwards? The purchasing power for consumers will rise. They'll be able to purchase as much as they can. So, those that are, yes, want to say something? Okay. Those that take mortgage loans will be paying a lower interest rate. And even if they are still paying the constant rate, it allows them, it's going to be lower because the interest rate is lower and it's automatic. As a result, they're going to have more money with them to spend. So because they are paying less interest on loans, it means their disposable income would rise.
It's good for the consumer in the business. But not
when the interest rate is low.
Yeah.
Yeah, it's good for the consumers. It's not good for those that save money.
Yeah.
It's not good for the savers. Because at that point in time, they get less return on their savings. So they won't want to save, rather they want to spend. So, are we getting the point here?
Yes.
So a low interest rate will increase the purchasing power of consumers, would make savers, would discourage savings. People would not want to save. They would rather want to spend.
Yeah, and then loan and then
investment will increase in the economy. The aggregate demand will increase in the economy. Then, in contrast, if interest rate is increasing, the first thing is that borrowers, those that are savers will be better off because they're going to have high return on their savings. Those that are borrowing have to pay high interest. Those that have mortgage, they have to pay high interest, reducing their purchasing power. That means they're going to have less disposable income.
so let's reduce the aggregate demand.
Reducing the aggregate demand in the economy.
So let's spend
They have less to spend because the cost of borrowing is expensive.
What's the difference, like high interest rate or low?
It depends on the situation of the economy. It depends on the situation of the
I
economy.
think low interest rate because the consumers will have money to buy from businesses and business.
Well, the point about low interest rates is that it will lead to inflation.
Yeah, to get that.
And high interest rates could also lead to recession, unemployment.
Yeah.
You get it? Any question about that? So go to firms. So for firms, what are the impacts of interest rates to firms? Firms using borrowed money, such as mortgage loans and overdrafts, to fund their business activity are likely to respond to changes in the interest rate. So if the interest rate increases, If interest rate increases, the cost of borrowing for firms would increase. Yes or no?
Yes.
So borrowing becomes expensive. Firms would be discouraged to invest or just lower. What is the consequence of this? Output will fall. And if output falls, firms will not be selling as they used to sell. They might need to reduce the number of workers.
So
Unemployment. Is it clear?
Yes.
We go on to the use of asset purchasing by central banks. So in recent years, many countries have tried to control the money supply using a method called quantitative easing. This involves central banks buying financial assets such as government bonds from commercial banks. This is done in the flow of money from the central bank to commercial banks. So we call it quantitative easing when the central bank comes up with a policy or an implementation that allows commercial banks to have cash with them. So commercial banks will be able to buy bonds from government in return of money. Do you get the point here?
Yeah.
So there's going to be flow of money from the central bank to commercial bank as a result of that. So that is the point they are making there. Do you understand the point, please?
Yes.
How or the use of asset purchasing by central banks. So if the central bank wants to purchase assets, they sell bonds. You buy bonds, they sell bonds to commercial banks. So when they sell bonds, it allows money to flow into the central bank. Is it clear?
Yeah.
So go on. Well, that's the end of our chapter 32, right?
Yes.
So we have this question. Let's read it together. They said, the first question says, which of the following is most likely to rise if money supply grows too quickly?
Yes.
Inflation rates. Wait. The second one, an increase in interest rates is likely to bring about which of the following? An increase in interest rates.
No, increase the saving.
It will increase savings.
Yeah.
Yes or no?
Yeah.
So that's the end of chapter 32. Thank you.